Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, all the best for the season, of course, and today we're taking a look at one of those bellwether conglomerate stocks listed on the Trinidad and Tobago Stock Exchange. We're speaking, of course, about Massy Holdings Limited, or Massy for short. Now, the group would have reported full-year earnings, which may have come as a bit of a surprise if you're looking at the headline number of earnings per share. But let's take a look and dive a little bit deeper into the numbers and see if Massy is indeed worth great value in the year ahead, and should investors be adding this to their Christmas wish list for the upcoming 12 months. Now, let's turn very quickly to that earnings per share, or rather financial earnings summary. And for that fiscal period ended September 2023, or FY 2023, the group would have reported an total earnings per share of 39 cents, which was a 6.1% decrease from the 41 cents per share recorded in that prior comparable period. Now, take that again with a fairly large grain of salt, because when we focus on continuing operations or sustainable operations earnings, we see that there was a very impressive 21.7% improvement in that EPS from continuing operations, from 33 cents per share in the prior comparable period to 40 cents per share. Again, that 21.7 odd percent. Revenues from continuing operations up 15% from 12.3 odd billion to just about 14.2 billion, with organic growth, but also importantly, acquisition activity contributing to that fairly significant improvement in revenues. Operating profits after finance costs would have improved 25.5% from 976 million to just over that $1.2 billion mark, and ultimately profit before taxes improving from 995 million to 1.23 odd billion in terms of 23.5% increase as well. Again, profit attributable to equity holders down 6.1%, but that includes a fairly sizable chunk of discontinued operations, which would have weighed on the total earnings per share figure, which would have been reported by Massy. When we take a look at Massy's profit before tax by segment in terms of contribution, it makes for generally good reading. Integrated retail improved year on year from 534 million to 654 million, a roughly 22.5% increase. Gas products would have improved from 305 million to 343 million, or a roughly 12.5% increase as well. So good reading there. Motors and machines also recovered impressively from 239 million to 262 million, a roughly 10% increase. Financial services modestly down just around 3% from 90 million to 87 million a year on comparable year. Now, one of the interesting stories for Massy has been its drive towards geographical diversification. And when we take a look historically at that geographical diversification strategy, we can see it has been paying dividends or achieving the desired results. Now, for example, Trinidad and Tobago, which is in that green segment, in fiscal 2019 accounted for just about 47% of Massy's total profit before taxes. With that acquisition activity and drive and focus into other geographic jurisdictions, that has come down to around 42%. Similarly, Guyana, with its rapidly growing economy, would have improved from 17% in fiscal 2019 in that blue segment to 23% in fiscal 2023. When taking a look at the USA in that very tiny purple segment, that would have improved from almost nothing in 2019 to up for around 5% in fiscal 2023. Supported, of course, by that significant acquisition of Rose supermarkets in the US. So certainly continuing and positive trend of geographical diversification of by Massy rather, and into areas where they would be earning ostensibly significant foreign currency to fund their overall operations and provide that level of enhanced investor confidence. Now, when we look at Massy's profit margins as well, we can see that there has been some recovery and certainly improvement, with profit margins well above those pre-COVID levels in the now concluded fiscal period. We can see that profit before tax margins were around 8.7%, improving from 8.1% in the prior comparable period of fiscal 2022. And those profit after tax margins also recovering to 5.9% from 5.6% in fiscal 2022. Certainly, those inflationary pressures that would have occurred in fiscal 2022 now seem to be abating, and Massy's cost containment initiatives combined with its revenue generation initiatives and acquisition activities also serving to improve some of those profit margins going forward. For the value-oriented investor, of course, the big question is, well, is Massy worth it? And now when we take a look at the continuing earnings per share, which gets rid of some of those discontinued operational gains and losses. So let's focus on that bright green segment. or bright green column rather, we can see that there has been a positive trend from that highly COVID-affected year of fiscal 2020 onward, where Massy was at in fiscal 2020 about 19 cents per share in continuing earnings. That has increased again with organic growth, economic recovery, and acquisition activity to its current 40 cents per share. What does that mean in terms of our relative value ratio? Well, looking at its continuing earnings versus its price, so looking at a continuing price to earnings ratio, we can see that from a high of 15.5 times in fiscal 2020, that ratio has dropped down to around 11.2 times, which does seem to be relatively attractive by any measure, certainly by Massy's own historical levels as well back in fiscal 2019, where it was around 11.5 times. So certainly trending in the right direction in terms of earnings growth. Maybe the share price has not quite matched those levels of earnings appreciation in the past few comparable periods. Of course, that is for investors to realize and bring to fruition in subsequent periods. Now, at a price of $4.45, Massy is trading at that reported price earnings ratio of 11.5 times. But again, focusing on that continuing earnings figure, 11.2 times relative to the sector average ratio of 14.5 times. So below the sector average, of course, with a dividend yield of 3.6% compared to the sector, which pays an average of 3%. So with continued revenue growth in mind, those acquisition integrations of course, also expected to bring further rewards for Massy shareholders and the company's financial performance in future fiscal periods. Continuing geographic diversification and, of course, those improving margins, Bourse is going to maintain an overweight rating on Massy for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773. Email us at invest@boursefinancial.com. And, of course, you can check out all of our research absolutely free on our website, bourseinvestment.com, and catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. And of course, we'll stay safe. See you next time and happy investing. And we'll see you again on the Bourse Report.